Hello, folks. Brandon Chapman with you today. It's another Monday video for TheoTRADE. It is December 18th, 2023, and what a week we're about to kick off here. Following the Fed policy statement last week, the topic is what's next. It's the aftermath of the Fed pivot. Last Wednesday was a major surprise right after several years of tightening. All the discussion about the inflation rate, about the fact we've not yet reached that point where they can start to get accommodative at the end of November, saying what? That we're still not there yet. Interest rates expect them to be high for longer. And all of a sudden on the Fed policy statement last Wednesday, we completely reversed that line of thinking and now suggest we're going to have 3 rate cuts next year, maybe as early as March. Of course, in the subsequent days after that, there's a little bit of a walk back. But the fact of the matter is, there was a very major announcement that came out last week, and look at the market's impact since then. And so oftentimes what happens is you get the initial reaction, and then you get the follow through. So if we kind of zoom this out here, we see before the policy statement last week, we're trading, or we closed at around 4650 on the S&P 500. Well, after the announcement, the market broke significantly higher, up about 1.7% on the day. We've inched out a couple of gains here, a couple of gains the last 3 days. Thursday we're higher, today we're higher. Friday we're actually down slightly. But the idea is, and I shared this with our members last week during my session, that look, expect to see a skewed distribution of returns post-Fed. And that's exactly what we saw. What we've seen is that after the announcement, the upside here, maybe a little bit over 2% at the highs. We came back on Friday, and on today we're back up again. But notice where we currently stand. Here we had major prints last week on Friday for about 1.9 million, 2.2 million print, 2 million shares traded in one print at 467.42. Again, that was kind of interesting because it did not show an intraday print at that level, and yet we saw stuff pop up on Trade Flash. Maybe it's a dark pool print from the couple days prior. The point being, this establishes a rather significant level at or near 467.50. Today we break above it. And so what happens is we establish a range here, 467.50 on the downside, and that's not a very good line there, but up on the high side, about 470. We kind of bring this up here, you'll see it's about 474. This is our range. If we can break out to the upside or the downside, and I'm not sure exactly which direction it's going to go. We'll talk about IWM and some indications that hedges are being placed just in case we break out to the upside. But again, we're seeing right now is the market is trading in a range post FOMC. And what this means is that the distribution post Fed was skewed, meaning what? We had very, very bullish news. Dollar weak news, right? Dollar weakness should spur significant gains in the market, all things being equal. Well, if we look at if we look at UUP, this is the dots to use dollar sign DXY. If you look at $DXY, which you saw those 2 days here, last Wednesday and Thursday, the dollar dropped significantly, predominantly against the euro/US dollar, right? The euro popped up here back to prior highs. If we look at look at the dollar in real terms against gold, you'll notice this day right here is a big pop in gold as the dollar weakened. And so if we look at kind of the relative strength of SPY plus GLD, we can see whether or not the market's gains were based on growth, based upon real value creation, or it was just a matter of the dollar losing value. And so we'll notice this is Tuesday's value on the yellow line here. This is the relative strength between gold and the S&P or SPY versus gold. The peak in the value of the SPY was on Tuesday, the 12th. Well, the Fed statement is the market went rallying higher about 1.6, 1.7%. Notice how it actually went down in gold terms. Why? Gold rallied more. The dollar weakened more than the S&P gained in value for 2 consecutive days. Now, the last 2 days, on Friday and again today, the S&P is gaining more value relative to gold, meaning what? The S&P is gaining real value, right? Versus nominal value, which is what the SPY or SPX or any just single symbol. This is the SPY against the dollar itself. If we strip out the impact of the dollar, this is SPY plus GLD. And what you'll notice is the S&P is actually down slightly. And so what we have is this response, right? The response to the Fed's surprising move to decide to project rate cuts, 3 rate cuts for next year. Leading into this announcement last week, we saw that economic data was a little bit better. Jobs were better than expected. Inflation was a little bit hotter than expected. What is the Fed actually signaling to the market right now? And that's what we're trying to figure out, right? That's what the market itself is trying to figure out. 10-year treasury yields took a nosedive, meaning people bought 10-year treasuries for a couple of days. But here's the point, right? Going into Thursday, Friday, all of a sudden, the rhetoric coming from Fed heads was somehow that, well, they're going to moderate that a little bit. Well, we're not going to really cut in March, right? Oh, we're not really talking about really cutting in March. But what was the dot plot that was put out? What was Powell saying in his testimony or during his press conference here? So let's take a look at the CME Fed Watch tool and see how things may have changed relative to last week, or more importantly, relative to weeks ago or months ago. So we look currently, right? This is the March meeting, right? March 20th. We're looking at what? 63 plus 5.5. We're looking at almost a 70% probability the Fed's going to cut in March. Has this changed? It's actually risen from a day ago. It's significantly higher than a week ago or a month ago. Nobody's taking what the Fed officials said after the Fed statement seriously. They're going by Powell. They're going by the dot plot, etc. We look at May. Okay, May is pricing in what? We're basically pricing in a 60% probability of another quarter point in May. If we look at December, we'll just bounce it all the way to the end of the year here. And you'll notice is that this has shifted from the 4 to 4.25% range, 28% probability a week ago, 29% for 4%, 16% here. We're shifting down. And what is this saying? We're looking at what? Greater than 50% probability. The Fed cuts how much? At least 1.5%. That gets us to 3.75% from its current value of what? 5.25% to 5.5%. So as we go back to this, who is correct in this? Are we really cutting a quarter point? Right now, the 10-year treasury yield is about 1.25 to 1.5 points below the current Fed funds rate. If they lower in March, they lower in May, all of a sudden we're eyeing a 10-year treasury bond yield at 3.25% or lower. If they truly cut 1.5%, in which case right now we're pricing in greater than a 50% probability, where does the 10-year go? Folks, this is where it gets nuts, right? I'm like, look at the IRX. This is a good proxy for what the current Fed funds rate is. We're continuing to see this kind of drip down here a little bit. We're currently at below 5.25%, pricing what? The fact that they're looking at the Fed cutting in the next meeting. But currently the 10-year treasury yields 1.25% to 1.5% below the current Fed funds rate, or where the 3-month T-bill is. What's happening at the moment is treasury yields are diving. And so I'm going to bring up TNX. We're going to look at the treasury yield curve. So I'm going to bring up load style down here, UST yield curve. We'll take this off of a percentage, and we'll look at straight price. We're going to look at this 1-year daily. And what you're seeing is it yields flipped higher today. But notice what happened here, right? 5-year momentarily above the 10. We dip below the 10. We're back above the 10, or basically trading the same level as the 10. The 30-year was kind of catching down. We're a little bit wider back here. We became a lot tighter here and even tighter here. So the point is this, if we continue to pricing the rate cuts, the 30-year is likely going to dive below the 5 and the 10, and we'll end up with a fully inverted yield curve. So we've seen that we flattened slightly from where we were at the end of October on October 31st. And in this rally, we've seen what? We've seen yields get tighter and tighter and further away from the current Fed funds rate, which is 5.25 to 5.5%. We're beginning to price in rate cuts. Is this commensurate with a significant upside move in the market, a stable an improving market and economy? The answer is, of course, no. Right? The 10-year inflation rate right now is probably about 2.5%, 2.6%, 2.7%. The 10-year yield's about 4%. There's a lot of room for that to fall relative to inflation rates. Is the Fed at this time now capitulating and saying, look, folks, we've had positive yields for about 6 months. Now what? Interestingly enough, Costco came out and announced that they generate about $100 million in revenue because they sell 1-ounce gold bars. Stock's up about 3.4% today. Right? Now, all of a sudden, we're looking at a company that may be generating revenue kind of like Mara, right? Bitcoin proxy, Mara through the roof today. /BTC hasn't even moved, right? We're still consolidating in somewhat of a pennant formation. Yes, I got a lot of retracements on here. Point being is we're forming kind of a pennant. We may break out to the upside. If we look at Mara is experiencing that short squeeze we've been talking about for weeks. And unfortunately, I kind of closed my Mara out in this point, continue to run over the last week here as the Fed has articulated a very dovish stance where they've been more hawkish over the previous few years. Have they done their work? Have all of a sudden we have no inflation concerns, or are they really just adjusting the temperature? We're now getting cooked at a higher inflation rate. Are they going to adjust that higher and say, look, we're okay with 3%. We're okay with 4%. The fact of the matter is the current Fed target of 2% has not been there historically, right? They've been at 0%. How is 2% stable prices? 2% is maybe slightly more stable than 3% as far as an inflation target rate, but the fact of the matter is 2% isn't even stable. So where is this thing going, right? As we look at GLD or gold right now, and we see where it stands, Mara taking off, but we may be setting up for another higher low and a year-end rally. This is a seasonal rally, generally mid-December into January. We may have stole some of the thunder with the rally back here in late November and also early October, but we may see this really run to the new year. Everything hinges on what happens, the outlook here. Now, interestingly enough, if we look at what's performing today, staples, right? Staples is one of the best performing industries or sectors today. Look at the top performing. This is a Dividend Aristocrats list, but look at the performing stocks in there, right? We got Hormel, we got Church & Dwight, Procter & Gamble, Colgate-Palmolive. I mean, these companies are what? These are consumer staple-oriented companies. Are we about to see a run? Are we about to see leadership in staples? Well, if that's the case, maybe utilities comes around here off of the lows after the big breakout last week. The point being is that we may be posturing much more defensively than otherwise. If we look at communications, Meta today broke out to a new high, right? Google, in fact, a couple of big trades in Google today, both in the 29 December expiration. We're up 2.4% on a close to a $3 trillion company. Short-term target might be 141. Look at the 29 December expiration in here. And what you'll see with Google for the 29Ds, we got the 138s mostly bought here, 30,000 contracts mostly bought. We've got the 138s, 144s in here as well, an upside call spread. There's a lot going on here, right? Is Google going to be the leader? Well, let's look back here. Let's look back 3 years. We have the 2021 highs. What is the bull case scenario for Google if things work out positively? It's crazy how many we've seen of these of late, but guess what? We have kind of a diamond formation, don't we? You got lower highs, higher lows, lower lows, higher lows, forming this diamond formation. If we take out that 138, 140 level, look at the range here, 120 to about 141. We're talking about $21 off a break of about 138. Well, guess what? That puts it maybe at 158, at least puts in a retest of the prior high on Google. We look at Meta today, right? Is there room to the upside? We see this breakout. Yes, we got 384. That's 40 points higher or 10% higher than its present level. Is it a foregone conclusion that these stocks are going to perform like this? The answer is, of course, no. Let's take a look at NVIDIA, right? It's a big cap tech name. We're at multi-year highs at the moment. Where does this go from here, right? We tested this level, 500, tested 500 again. We're back at it again today. We load the volume here. Volume is about average for the most part today. Do we break out? Well, guess what? There are trades that are being made right now that are taking swings just in case things break out. So let's take a look at NVDA. Notice out here a 5-point wide long call vertical, buying the 540, selling the 545. The skew is not negative, it's slightly positive. You're buying the lower vol, selling the higher vol. A slight edge in that, right? Well, what does this do? 545, 540, 545. We're looking at NVIDIA getting up here. It's a really cheap spread, right? It's costing me 60, 70 cents on a $5 wide. And if NVIDIA takes off, guess what? That could pay some dividends with relatively little risk. Here's the thing, folks, and this is the interesting dynamic that's playing out right now. And you got to understand skew a little bit, but here's the deal. Okay? IWM, we'll back this out 3 years. Okay? IWM right now is at about 200. The highs, 230 to 240 in IWM. Today, trade in this day wasn't on the trade and today on IWM. There was last week. The point here is this. I took a trade in it, but the point is this. IWM, this is really interesting. In fact, let's go back and look at skew here. Skew for the S&P 500. We do not have the value for today, but Friday closed at 153. We were at 162 last Thursday. Near record high levels of skew. What this means is the downside risk, the distribution, the downside risks are preeminent in the S&P 500. The upside opportunity is minimal, okay? That goes back to the notion as to why my thoughts on the S&P 500 is that the reaction, and I shared this on Tuesday and Wednesday last week before the Fed meeting, is the upside is minimal if we surprise. And what a massive surprise that announcement was. The downside is big, right? The downside is big. But then all of a sudden you look at IWM, and what you see is that the skew is positive. So we come out here, let's look at a 20 DC expiration, and we're going to look at the implied volatility. Notice here the implied volatility is falling, 28, 27, 26, 25, 25. We kind of bottom out here at about 192. If we look at the call side's increasing, 18, 19, 19, 20, 27, 36. What is going on here? Why is it the volatility is falling on the put side out of the money and it's rising on the call side? This, my friends, is positive skew. It's the exact opposite scenario that we're seeing in the S&P 500. What's happening, I read something over the weekend talking about this, is what? That hedge funds out there using IWM to hedge their short exposure. Well, how do you hedge short exposure? You buy calls and you sell puts. And so what happens here, we're creating positive skew, meaning what? That we may squeeze significantly to the upside in IWM. Okay, so what that means is the risk right now in IWM is to the upside. Well, who's correct? We have near record high skew as of last Thursday in the S&P 500, and yet we have almost unprecedented positive skew in IWM. Who is going to play out positively here? You have institutions that are long the S&P 500. They're buying puts and selling calls on the S&P 500, the SPX index. They're doing the exact opposite in IWM. We have the shorts hedging their upside. Okay? So we have two different categories of investors, both hedging at near record levels at the moment. So what does this point to? Nobody has a clue. But what does this mean for you in your own individual trading? Well, guess what? If you're looking for something to hedge the upside, IWM is expected to probably outperform. Now, if we look at the sectors that are represented in the Russell, scroll down a little bit. Financials, industrials, healthcare, information technology, consumer discretionary. Where is there room in this to move? If we look at financials, let's bring up XLF. Now, again, this is S&P 500 financials, right? We could possibly look at KRE, would probably get us there, right? I guess if regional banks were to really take off 65, 80, is there room to the upside? Absolutely. But what is it going to take for this to get there? It's going to take yields on the 10-year treasury yield to really come down hard and fast. Is that going to happen and the market be on good footing? Probably not. So let's look at another sector here, right? We've got industrials, XLI. Oh, we'll use just XLI as a proxy here. XLI is at multi-year highs, if not all-time highs right now. Fact of the matter is, this isn't a terrible short. And I realize this is S&P 500 companies and not Russell 2000 companies. Again, you can look at this up here and be able to see it, right? UFPI, we've got Fix, Comfort Systems, we got SSD, Simpson Manufacturing. So again, you might see the smaller cap names ultimately play out, but look at SSD here, right? One of the top holdings. This looks like a great short opportunity, doesn't it? So what areas within the Russell potentially provide that upside opportunity? Again, financial, I think we're long in the tooth there, right? Information technology, long in the tooth. The areas, consumer discretionary, energy, those might be points. Real estate, I guess, if yields keep falling, we might see a rally in financials and real estate there. But the fact of the matter is energy, consumer discretionary are probably two areas that are probably looking the most positive right now, and the fact that they're not as high. So let's look at XLY. Again, this S&P 500. But if we go back here 3 years, where do we stand? There may be upside here in cyclical names. Okay? But the fact of the matter is the rotation today for the S&P 500 was much more towards staples. Over the last 3 weeks, over the last 3 weeks, staples is towards the bottom, real estate's towards the top. Again, are we going to start to see rotation? You might get it towards staples, right? The lower performing communications, utilities, healthcare, right? These are the names. Energy is the worst performer in the last 3 weeks, and it's the worst performer in the last 6 weeks. So if we look at these bottom performers here, in particular, staples and energy, this could create some near-term opportunity. And that's what we saw a lot of today, right? From a unusual option activity perspective, I'll share one with you in XLE. Okay, yes, XLE was up 0.82% today. But look at this, right? XLE, this was a January. So we get out here January at the 89 strike price, right? We saw buyers coming in at the 89. We saw it also with PSX. This is a refiner, but PSX, it was the March expiration in here, the 135 strike. We saw it with Williams, WMB. This is more of like an infrastructure play. But anyway, for Williams, it was the Jan 36 strike. We're looking at right here. Again, buying activity in these names in the energy space. Okay. Are we oversold in the near term? Yeah. Could we get a rally towards 36, 37? Absolutely. So the point being is that where do you look right now? The fact is, looking at risk-off type sectors, staples, utilities, that's an area to watch, right? Another could be energy. Why? Energy has lagged. Energy has underperformed. We're trying to find some area, if the market's going to go higher, that may perform well. And as a catch-all, you got IWM, right? We talked about a potential spread here. God, look out, for example, to, let's say, a 12 Jan. Let's actually try a January expiration. Again, we got the positive skew out here. You could buy low and sell high. Buy a 198, sell a 200. Buy a 200, sell a 205. You have the ability to stretch out here. And unfortunately, with thinkorswim, they're missing some strikes in here. There's $1 increments, and this platform is not updating like it should. But the fact of the matter is, there is upside buying going on here, and this through hedges. And you can buy lower and sell higher and capitalize on the rising vol structure, buying the lower volatility and selling the higher volatility, creating a slight edge. And again, is IWM going to outperform? Well, guess what? If we look at it recently, plus SPY, what you'll see is that, let me bring up the pairs ratio study here. This is just a relative strength line that you can construct on the fly. Since the lows down here on November 10th, 11th, IWM's outperformed. If the market's going to rally big, IWM is probably going to lead. We've got the January barometer effect. Generally speaking, small caps outperform in January. So again, we may have more lift here. So placing something on in IWM or something like NVDA, those kinds of scenarios where the vol skew is positive or favorable. Okay. Looking at consumer staples, KHC today. Kraft Heinz. I always want to add carry for some reason, but I know why, but anyway. But Kraft Heinz today. Now, Kraft Heinz has seen a short-term pullback. We see kind of a spinning top candle after a little more of a downdraft on Friday. And today in Kraft Heinz, it's a 22 dece. It's this week. It's at the 37 strike. We get this gamma level. If we start to trade through, could cause this to pop and trade higher. Now, again, for 4 days out, we do have this positive skew. You could go that short if you want, but let's try to see how far out we can get. Notice out here, 32 days. You could buy a 37 and sell a 40. Buy 16%, sell 18%. 37.5's right here, 40's up here. The higher volatility out here at 40 means there's premium to sell. Well, actually, there's not. So what you might want to do instead, go out to Feb, just buy the 37.5. 90-cent cost. You eat in here in between the spread here, maybe it's 87, and you have a chance to just play the movement of KHC. Just kind of look at the lows down here. If you close below it, just take the low that day. That's your exit. Okay, but the point is KHC right now is catching a bid. We've seen bullish option activity all the way since the lows back here late October. So the option activities continue to play out positively and driving it. We get the sell-off here, the pullback. We got a 61% retracement. Actually, got to redraw that maybe, but anyway, we probably got another leg higher here that could see this price go to probably 38.5, maybe as high as $40, $39.5. Okay, in KHC. This one is interesting. Walmart had some devastating news, right, on its earnings. But here's the deal, folks: is the consumer down or are they out? Right now, I think they got knocked down. Fact of the matter is, what is Walmart going to do? Notice the big volume on Friday. Stock didn't move a lot. What you're seeing is a bit of an impasse that was resolved today with the breakout. Now, the breakout didn't occur on substantial volume, above average volume. That's 20-day average volume there at the blue line. But we had big volume last time. We're seeing it resolve to the upside. A retest of the high of the gap day back here at approximately 159 seems pretty reasonable. Well, Walmart today, this was a shorter dated expiration for 22 December. That's for this week. 22,000 contracts, mostly bought at the 160 strike. Guess what? That's back to where? Prior highs. We got a target and we got a time frame. And we got 4 days. Maybe give yourself just a little bit longer. 32 days. Notice the vol is kind of squishy out here. Drops and then pops, right? What if we get something a bit closer? 5 Jan. Notice in here, 15%, 15.3, 18, a 155, 160 spread, right? That cost you maybe about $1.60, $1.65 on a $5 wide spread for 5 Jan. That gets you in the turn from 2023 to 2024. What about 29 Jan, getting into the end of the year, right? The Santa Claus rally, 155, 157.50, right? You can get that on for less than $1. A $2.50 spread. And again, if this thing gets to 160, great. This thing gets a little north of 157.5, you probably have a chance to close it for maybe a 70% gain. So Walmart right now, a bounce, a pullback, a bounce, a higher low, and a higher high. We're just looking at this to get a retracement back to the little high of the gap days back here. Now, if the market's going to go higher, Amazon, you'd expect, would participate. Amazon broke out today. Go back 3 years. We have room to the upside to about 188. That's about 35 points, 34 points higher than its current level. We just, of the last few days, broke out from a 61% retracement of the downtrend. And again, the expectation is we may get here. Now, again, if the market is strong and it holds together, Amazon has a chance to be a leader here and participate with it, or at least be coincident with the S&P 500 not outperforming a little bit. Today's trade in Amazon. This is out there a little ways. This is out there in June 2025. So we go way, way out here, right? We scroll down, and what do you got? This 170. Now, my guess, that's probably weren't sold previously. We're probably adding to that. I would look at this as being a buying the 170 and selling the 220, a $50 long call vertical spread. Even if we're rolling that out, we still kind of get that 220 target here. But point being is that what? 220 is way up here, isn't it? Go back 3 years. 220 is above the highs back in 21. Now, granted, that's out there a little ways. This is a reflection of money flow, right? We're kind of flowing into Amazon here today. Again, could you do something a little more reasonable, shorter term in nature that benefits by rising volatility? And if we come out here, notice that there's not much of an impairment. You could get a January. There's not much of an edge in here. Could you get a 155, 160? Buying here, virtually the same implied volatility. We got a very, very flat curve out here. You could pick up almost any, buy the lower, sell the higher, and there's not any impairment. 155, 160. 155's right here, 160's right there. What does that cost you? 430, 160, 233 may cost you about $5 spread. May cost you about $2 on a $5 spread. That's not much movement, right? We don't have to go very far to get to 160. Buying at the money, we can get in the money pretty quick. Break even's about 157. That's by expiration. You get through 160 here, you're probably able to close it out with a reasonable profit. Okay, we'll wrap it up with a couple of bearish trades that are kind of showing up today. So we really talked about financials, Synchrony Financial, consumer financial stock. We've had such a phenomenal run here, right? A short squeeze. I mean, this is defined the current trend in the market. We're back at prior highs. Today in Synchrony Financial, a couple of puts bought for Jan. And we look in here, January expiration, the 34 strike right here, mostly bought. Again, what are we looking at here? Downside in Synchrony Financial. Now, granted, this is one that's going to require the market to probably tip with it, but this is an area to look at to play the downside. With the $34 target, it's really easy in these kinds of stocks to buy the higher strike and sell the lower strike. The vol is very minimal to buying 30, selling 32, buying 31, selling 34. You could reasonably put on a 37.35 for about 55 cents. 35 is right here. You start to break below 35, you close that out for probably close to 70+% gain. This is benefiting by very overbought levels. So you got your swings to the upside, IBM and NVDA, maybe Google, and then you got your swings to the downside in Synchrony Financial. And another one in the financial space is KeyBank. So this is a June expiration. So we go out here all the way out to June 2024, 4,000 contracts bought here. Again, looking at downside, we're building some downside money flow. Could we pull back to 12? At some point, we're probably going back to 10 again. Don't know if it's going to happen in 30 days, but you could buy a spread in here, right? You could take a swing to the downside. 14 and 12, it costs you 45 cents on a $2 wide spread. $12 is right here. You're risking a little. Plan on the max loss. This could be a big winner if we roll back to $10 and we see the selling going to the end of the year. So the idea is you can take very limited risk, high reward trades going into the end of the year, beginning of January. And again, you got to be profitable on a couple of those. So let's say 2 go bad, 2 go for you. If you get over 100% return on risk, you're probably paying for your losses, right? So the idea is you can take swings on both sides, and guess what? You may be right on both as well. Well, folks, we're going to wrap it up there. It's a longer video than normal. But anyway, have a great one. We'll see you back next week. Thank you.